I put 10% of my fund at the time in Amazon at $10 a share. And very quickly it got to 14 and I moved on. Okay. Very dumb. Okay. There can't be things that are more dumber than that. And that's like a 330x that got blown away.
To put this massive mistake into perspective, at the time, Mohnish Pabrai was only managing $70 million. Even if he had kept $7 million in Amazon and nothing else, today that $7 million would be worth over $2 billion. That's nearly the entire value of his funds today. This idea of investing in the right stock and just letting it ride is not Mohnish's. Mohnish Pabrai was actually heavily inspired by Nick Sleep, who famously closed his hedge fund after finding his 3 forever stocks. Based on his learnings from Nick Sleep and others, Mohnish has completely pivoted his investment philosophy from buying discounted value stocks to buying what he calls apex spawners. His new investment philosophy can be broken down into 3 simple rules: buy small, buy apex spawners, and buy no-brainers. Hi friends, I'm Maaiz Khan, an ex-hedge fund analyst turned entrepreneur, and on this channel I share the research I go through to build my own investment strategies. So let's break down exactly how Mohnish intends to find his next Amazon.
Businesses that will do a lot better in China are businesses today that may be private, or businesses that may, be worth less than $1 billion or less than 100 million, where their runways are huge and they've got competitive advantage and they can grow 100x from here.
So how do you maximize your chances of finding a multi-bagger stock? You can do so by starting small. Mohnish mentions that not many companies grow to be $100 billion businesses. Only 9 businesses that IPO'd in the last 20 years exceed a market cap of $100 billion today. In order to increase your chances of finding the next Amazon, Pabrai assumes no business he invests in will exceed $50 billion, since most don't. With that assumption in mind, the smaller the company is, the greater the runway it has. To get a 10x on your investment, you need to buy a company that's below $5 billion. And to get 100x, you have to buy a company that's below $500 million in market cap. The data really backs up this rule. Altifox Capital's study on multi-baggers found that 83% of the stocks that returned more than 350% between the years of 2015 and 2020 were below the market cap of $2 billion. In other words, the vast majority of multi-bagger potential lies in small companies, and the smaller you go, the greater your chance of return. Apart from the great runway that choosing a company that's very small provides, it also reduces the amount of competition you have as an investor. For instance, if you choose to invest in Walmart or Costco, you'll have dramatically less information than well-capitalized investors like Bill Ackman. Bill may be spending tens of thousands of dollars on drone footage of Walmart parking lots to figure out how many customers are going in and out every day, whereas you won't have that kind of money to put behind your investment. He may even pay to speak to the suppliers of Walmart through a company like GLG, and he'll find whether or not they're increasing their inventory or decreasing it. On the other hand, if you invest in a smaller, underfollowed company like The Joint Chiropractic, you might be able to get in conversation with the management themselves, because there are only 2 or 3 analysts on the conference calls. You could even call up a couple of their franchise stores and get an idea of their business. Whereas to do the same thing from Walmart, you might have to call hundreds of stores. Competitors with large research budgets won't be able to buy into these smaller companies because they won't move the needle for them. Lastly, by buying stocks while they're small, you might be able to hold them longer because they have a much longer runway. You can save on taxes by buying stocks that you plan to hold for a longer period of time. When you compare this type of investing to what Mohnish Pabrai was doing before, where he was maybe selling his stocks every 1 or 2 years, each time you sell a stock for a new stock, you might lose 15 to 40% of the return you gained to the taxes. Whereas if you own a stock for 10 years, the deferred tax savings on an individual level start to add up. Now, there's a lot of small stocks, but how do you find one that will have decades of growth ahead of it? That's where apex spawners come in.
Apex spawners are very rare, and apex spawners can be amongst the very best investments you can make because they've got so many different ways to nirvana. They've got, it's kind of a Swiss Army knife. They can bring out different tools, and they're really good at all of the above.
So what is a spawner and what makes it so special? And how do you find them? These are companies that maintain a deep underlying culture of creating new businesses related or unrelated to their core business. These new businesses they create can become massive growth engines for the company overall. These spawners can be broken down into 4 different types. First are adjacent spawners, companies that create businesses related to their main business. For instance, Amazon started by selling just books online, and then they expanded by moving into other verticals aside from books. That is a version of adjacent spawning. Starbucks is another great adjacent spawner. Both the Frappuccino bottles that you'll buy at the grocery store and the Starbucks Reserve coffee stores are great versions of adjacent spawning. Next are embryonic spawners, companies that buy other businesses while they're small and then nurture them into massive businesses. A great example of this is Facebook buying Instagram and then Oculus. These are both companies that were bought at a much smaller stage in their life cycle and have grown dramatically. Third, we have cloner spawners. These are spawners that do not innovate. Rather, they just copy what already exists out there in the market. Microsoft is a great example of a cloner. They've cloned Windows, Microsoft Excel, Microsoft Teams, and Azure. There's probably many more that I've missed. And fourth, there are non-adjacent spawners, companies that are able to go into new businesses that have nothing to do with their core business. Alphabet is a great example of this. Even though Alphabet is mainly known for Google search, it is also leading the charge in Waymo, in driverless cars. Lastly, an apex spawner. Mohnish's final goal for his portfolio is a company that's able to deploy its capital in all of these 4 ways. Now that we know what an apex spawner is, why are spawners better than other businesses? First and foremost, spawners are tax-saving machines. Instead of paying taxes on their income, they use their income and reinvest it into high ROI businesses. This is even more tax efficient than companies that buy back large amounts of their own stock, because spawners are able to reinvest their capital before it gets taxed at the corporate level. This can have a huge effect. Alternatively, if the same company was to return cash to its shareholders, the amount lost to taxes is actually staggering. For instance, in the United States, you could start with $100 of earnings and expect 21% of that to go to the federal government for corporate taxes. So you're left with $79. Now that $79 goes down to $49.77 after federal taxes. And if you're in a high tax state, that $49 could go down to $38. So if a company can invest and get a reasonable return on $100 of earnings, they are much more likely to do better than you as an investor who's taking that $100 and is only able to reinvest $38 of it. These tax savings add up to a lot over the long run. Second, spawners are better because they're more likely to last. All businesses mature over time and slow in growth. Spawners, on the other hand, can continue to grow by moving into new businesses over time. Spawning allows a company to stay on the cutting edge by continuing to focus on the growth versus cutting costs. For instance, think of a company like McDonald's. At this point, McDonald's is far past its highest growth period. As a result, much of the company is focused on reducing its costs versus the growth. And hence you can imagine the company culture at McDonald's headquarters versus a company like Tencent or Alibaba, which are at the peak of their growth. So now that we know why spawners are such great investments and why we should find them early, how do we find them? Finding an apex spawner isn't as easy as running a screen on finviz.com, but it's not that hard either. All you need to do is answer these 2 questions.
We have to look at, does it have strong spawning DNA? Does it have a great capital allocator running it? And what I found about spawning is that you don't need to make heroic assumptions. Even a $500 million or $300 million business will have enough trademarks in the past from the time they were private and when they were public, which will make it obvious to you that this company has spawning DNA or doesn't have spawning DNA, and the nature of that DNA.
Mohnish Pabrai specifically looks for no-brainers when it comes to spawners. He's looking for companies that have shown a history of spawning DNA. And if he doesn't find that in the company, he has to have it in the management of the company. Spawning DNA is really well explained by this quote from Jeff Bezos. Staying in day one requires you to experiment patiently, accept failures, plant seeds, protect saplings, and double down when you see customer delight. Spawning in itself is not the only characteristic that makes an apex spawner a good investment. You also need a team that is able to reallocate the cash that company is producing into new high return businesses. Often finding good capital allocators is pretty difficult. Many investors of Meta, the parent company of Facebook, WhatsApp, and Instagram, worry about Mark Zuckerberg and his capital allocation. They worry that Zuckerberg's massive investment in the metaverse is not going to pay off. Unlike Amazon's Jeff Bezos, Zuckerberg is betting a substantial portion on a relatively nascent business that has yet to prove product market fit. Only time will tell if it'll pay off, but you can see why Mohnish Pabrai has not bought Meta stock. He worries about Mark Zuckerberg as a capital allocator, despite Meta having an amazing track record of being an apex spawner. So with these three rules of buying small, buying apex spawners, and buying no-brainers, you might be able to find your next Amazon. Though the vast majority of companies you'll come across won't fit the bill for an apex spawner, those that do could be forever holds. As a result, finding one apex spawner like Amazon or Tencent can and will often outdo all of your other investments. It's no wonder Mohnish Pabrai has shifted his entire focus to these types of companies. Thanks for watching. If you enjoyed this video, definitely check out my next video on one investor that's been beating the market for 20 plus years by buying serial compounders.